So you got our first question here. Explain the nature of business and financial risk. So quickly read through the scenario of situation. Quickly read through the scenario before we can address the question. Let us answer this very common question. It says, explain the nature of business risk. So what is business risk? What creates business risk? Is the risk which is created by what? Or which is driven by what? The nature of the business that you are in. So this risk is related to the nature of the business that you are in, or to the industry that you are in. This is a risk which is associated with the type of industry that you are in. And what factors differentiate one industry from the other? What are some of the factors? It's the pattern of demand. The cost structure. Pattern of cash flows. So different industries will have different features in terms of patterns of demand, the cost structures, and also the cash flows. Yeah. And we normally say that this is a risk that your business may fail. The business fails, where the revenue cannot cover the costs. So this risk is caused by the type of business that you are in. It's associated with your industry, in the sense that different industries have got different patterns of demand, cost structures, and even cash flows. This is a risk that your business may fail because revenues cannot cover the costs. How do you assess this risk? How do you assess this type of a risk? How do you assess business risk? Because the question says you must talk about how you assess the risk. So how do you assess business risk? The answer is use operational gearing. You use operational gearing. That's what you use. The concept of operational gearing. And operational gearing is measured as your contribution divided by your profit before interest and tax. Contribution divided by profit before interest and tax. That's how you measure operational gearing. It's really a measure of your fixed costs, the level of fixed costs that you have in your business. Okay. For instance, this move here, if you are diversifying into manufacturing sector, if you want to move from the hospitality industry, you want to go there, this will lead to a change in business risk. Will lead to a change in business risk because you're crossing from one industry to another. The patterns of demand, patterns of costs and cash flows are different in manufacturing industry. What of financial risk? Financial risk is caused by capital structure. Financial risk is caused by capital structure. That's what causes financial risk. And particularly what type of capital? Debt. So financial risk is caused by capital structure. And this risk is created by debt finance. So this is caused by debt finance. How is it assessed? Use a gearing ratio. Financial risk, if you want to assess it, use a gearing ratio. Which is debt to equity. Or it can also be debt over debt plus equity. So you can use the gearing ratio. You can also use the interest cover. Which is profit before interest and tax over interest. Profit before interest and tax over interest. So you can use interest cover. So high levels of financial risk, high levels of debt finance do cause financial risk. The risk that a company can fail because we're not able to service our debt obligations. Discuss the objective of working capital management. The objective. Now, the way this question was asked, you'd find it difficult to apply your 2 points because we learned that the 2 objectives of good working capital management is you want to maximize profitability, and at the same time you want to maximize liquidity. So the 2 objectives of good working capital management is to maximize profitability and liquidity. Profitability, we're talking about return on investment. We're talking about return on investment. For every $100 invested, how much profit are you making? So if you manage your working capital very well, you're going to maximize the profit on every $100. Liquidity refers to your ability to settle invoices. Do you have an ability to settle invoices as they fall due? These two normally conflict. There's normally a conflict between these two. If you go more on one, the other will suffer. For instance, if you want to maximize profitability by investing long term, you're going to have a problem with liquidity. If you want to have a lot of liquidity, the profitability will be affected. So good working capital management entails that you strike a balance. You strike a balance. So this item of objectives of good working capital management is a common one, which has come again and again and again. Discuss whether it's appropriate for big to have only one objective. What objective is that? Maximize the shareholders' wealth. Is it appropriate? Should the company only have one objective? The answer is no, isn't it? Because that one is a primary financial objective. So we don't disagree. That is a primary financial objective. So we don't have a problem with that one. Yes, we agree. Okay. But we also have secondary financial objectives. The secondary financial objectives. In terms of liquidity management, sales growth, maximization of profit, management of financial risk, so for you to achieve this primary financial objective, you need secondary financial objectives. Not even that, you even need to have non-financial objectives. So in this question, you're supposed to mention, yes, the primary financial objective is maximization of shareholders' wealth, that the organizations, and we call that, we label that the primary financial objective. But organizations should also have what? Secondary financial objectives, which will help us to meet our primary objective. So if you do well in the secondary financial objective, we should be able to meet your primary financial objective. Okay, so that was our first question there. That was our first question. Now, we're going to go into a serious working capital management question, and we start with inventory. Inventory. So inventory management. So we have spoken about the working capital management, and we said working capital management should lead to improved liquidity and profitability. But what does it mean to manage inventory? Well, it simply means that we need to manage. What does it mean to manage working capital? It means that we need to manage the individual elements, inventories, receivables, payables. Cash. So working capital management involves managing or monitoring these elements. Okay. This question has got other items, but it's starting with inventory. How do we manage inventory? Well, we covered the inventory management models. We covered inventory management models. What are these inventory management models? We say that primarily in the exams, it's the use of EOQ. Also, you can use GIT. We can also use inventory control levels. Or stock turnover ratios. So these models can be used, the EOQ, the just-in-time inventory control levels, and also stock turnover ratios can be used. The question on inventory tends to be almost the same question all the time, where they ask you to compare two inventory policies and the comparison using the figures. Inventory policies. So you're given two ordering policies and do a comparison and you recommend. So that is a key question that you can expect here. It's a comparison of two policies. That is what we expect. So in this question, there are two policies. We are going to compare them. Okay. Calculate the annual cost of the current policy. Calculate the annual saving if the EOQ is used. Okay. So let's go. Let's look at the question. Okay. So let's go. When we get a question like this, we just need to arrange our costs in terms of two items. Is what we do. Look at the current policy. And the current policy, you need to give us just the ordering costs and the holding costs. Okay, so the ordering cost and the holding costs. So ordering costs, look at the number of orders multiplied by the cost per order. Okay, for the current policy. So let's go. Annual demand is 285. Okay. The company places 20 units of the product at regular intervals. So how many orders? So it's 285. Divided by 20,000. That's the number of orders. Then multiply by the cost of placing a single order. The cost of placing an order is 65. So multiply by 65. So this is the cost. So that's the cost. So we go 285,000 divided by 20,000 multiplied by 65. So that's the cost there, the ordering cost. What's the cost there? The holding cost. The holding cost is half of the order quantity. Half of the order quantity. But where there is buffer, so if there is no buffer, the average number of items that we keep the average number of items held is half of the order quantity. Okay. Where there is buffer, the average number of items is buffer plus half of the order quantity. That's what you do. So here they have said that they have got a buffer inventory to meet 15 working days. So the buffer inventory is 15 working days. If we assume that is 365 multiplied by the item for the whole year. So this is your buffer. How much is that? How much is that? Mm-hmm. 15 over 365 multiplied by 285. How much do you get?
11,712.
11,712 plus half of the order quantity, which is 20,000. So that gives us how many items? 21,712. So this is how you calculate the average number of items held. Then you multiply this by 100 ingwe. 100 ingwe is what? 1 kwacha. So if you got a question on inventory, most likely the question would be modeled on what we have seen here. I hope you have seen how to calculate average number of items when there's buffer. So you need to find the buffer. Sometimes the buffer is even given. But the buffer also is what we call minimum level of inventory. Minimum inventory. The buffer is also called the minimum inventory. And remember, there's a formula for this. Minimum inventory is what? It's your reorder level minus average usage multiplied by the average lead time. Okay. Okay, so in case it's not given, buffer stock is the same thing as minimum inventory. Reorder level minus average usage multiplied by the average lead time. Or you can give it the way it's been given here. Let us formalize this now. We have done it. So let's now come here and put it in. So the average, the holding cost was, we got 15 over 365 multiplied by 285,000. Then we add 10,000 by 20. Okay. Then multiply by 1. Okay. Plus so that's the cost of the current policy. Now they say go EOQ. Let's calculate EOQ. Please, can you calculate EOQ, all of you? EOQ. Let's calculate the EOQ. Two multiplied by the cost of placing a single order, which is 65, multiplied by annual demand, divided by the cost of placing a single order. Let's go. What do you find? What is our EOQ? What is the EOQ? What is the EOQ? Anyone who has an answer?
I'm getting 6,087.
That's the one I'm getting also.
That's what you're getting as well.
Yes, sir.
Okay. All right, that's what I'm getting too there. My computation is showing the same figure. 687. So let's go. You've done very well. 6087. Okay. Here, the buffer still remains, eh? The buffer still remains, eh? Is that okay? The buffer still remains. The buffer still remains. The buffer still remains. Is that what we are getting? Here. Is that what we are getting?
Yes.
Okay. I hope we have seen how to calculate the ordering costs and holding costs. Because if you got a question on inventory, basically the questions are about making this comparison. So I hope each one of us can ably calculate the ordering cost and the holding cost. If you're able to do that, then you can say, look, I'm okay basically with this topic. Yeah. So this is how we calculate the costs. We focus on the holding costs and ordering costs. What are the other aspects of our question? Explain 4 factors that Mambo should consider in formulating his working capital policy on the management of customers. So what are the factors that must be considered? How much credit should we give to our customers? What factors are you going to consider? What's the cost of finance? Because these receivables have to be funded. What is the industry practice? What's our risk appetite? What is our liquidity position? So these are factors that to consider. The cost of finance. How much will it cost us to finance these receivables? What of industry practice? What's the industry practice? What's the risk appetite? What's our liquidity position? What is our expertise in debt collection? Do you have any expertise in debt collection? So these are some of the factors that we are going to consider. D, explain the meaning of the term overtrading and some of the typical characteristics. When is a business described as overtrading? When is a business described to be overtrading? When is a business described to be overtrading? Doing too much, too quickly, too little long-term finance. So you're ambitiously growing your business, but you don't have adequate long-term finance. Now, we've just been looking at long-term finance in terms of debt and equity. I'm sure you now understand the concept. So you're trying to grow a business very quickly, but you haven't organized adequate funding. In other words, it's a business which is undercapitalized. What are the features? We are going to see evidence of rapid growth. So you're going to find rapid growth. So what is rapid growth? You're going to see growth in sales. You're going to see growth in receivables. You're also going to see growth in inventories. So you're going to see growth in these items. That's evidence that the company is growing. But you're going to find no movement in long-term finance. No movement in long-term finance. Your non-current liabilities and equity are at the same level. That's what you're going to find. What else? You're going to find a huge overdraft figure. And you're going to find the long payable days. Long payable days. So basically, these are the features. There's going to be an evidence of growth, that the company is growing very fast, that you're going to find. Then also you're going to find no movement in long-term finance. So you're going to find huge movements in the overdraft figures and the payable days. Okay, so that was our first and second questions. First and second questions.